and they see that I don't have a loan, I would assume that I'm a better client for the bank.
Nobody buys a loan, they buy a house, they buy a car, and loan is just a means to it, right?
Can you get a loan without a credit score? If you don't have a loan, do you have a credit score?
The score is an algorithm.
Unfortunately, I've seen a lot of people even use credit cards to withdraw cash.
The most critical aspect of your score is repayment track.
There is no other way but for you to have a credit history for you to get what you are really looking at.
Our score summarizes the information which is available in the credit report and presents it in a numeric fashion.
I think thanks to the influencing community, all of us want to gather more points on our credit cards.
Yeah. Picture this. You've always dreamt of owning your own home. Like most of us, you can't go out and spend a couple of crore to buy it. So you want to take a loan. You hear the interest rates have been cut by the Reserve Bank of India and you assume that you'll get a great deal. In fact, you've read that 7.5% is the going rate. Except when you go to the bank, you're told that you'll have to pay 8.5%. That sounds unfair. And when you ask why, you're told that your credit score is too low. What led to that? What even goes into the calculation? And can you improve it so that you get a better deal? This is Moneywise on NDTV Profit, and that's what we're talking about today. Joining me today is Bhushan Padkil, who is a Senior Vice President and Head, Direct-to-Consumer Business TransUnion CIBIL, and Kirtan Shah, the Managing Director of Credence Wealth. Thank you so much, gentlemen, for taking the time. Pleasure having you on Moneywise. Let me start with, and I must establish that over the course of this conversation, I want to bust as many myths about credit score as possible. It's a concept that a lot of people speak about. So first and foremost, can you get a loan without a credit score? If you don't have a loan, do you have a credit score? I'll start with you.
Perfect. So first of all, thanks for having me at the show and picking this fantastic topic, which actually touches lives of millions of people today. And like you rightly said, nobody buys a loan, they buy a house, they buy a car, and loan is just a means to it, right? And when it comes to these loans, you need a score. Why? Because if you look at lenders, when they underwrite a loan, they want to look at establishing certain aspects of consumers. For example, consumers' creditworthiness, consumers' capacities, and contactability, right? Now, when it comes to contactability and capacity, the income documents and ID documents comes into play, the typical KYC documents. But when it comes to creditworthiness, that's where lenders want to look at their score, and the why. You must be questioning why of it, and so is lots of your viewers as well, that how credit score determines the credit worthiness. So a simple answer to that is, if you have ever looked at your credit report and score, and in this case I represent CIBIL. Now CIBIL is one of the leading credit bureaus, the first credit bureau and leading credit bureau in India. And when it comes to score, CIBIL score is a household name today, right? Now when lenders look at a report. Now, report has a lot of information. A report has information around your loans. A report has information around your, ID details. Reports have information around your, inquiries, credit inquiries that you have made. Now, what lenders want to do is they want to look at all this information and how they can summarize. And our score does it precisely.
Is it important, Kirtan, I'll come to you, because there is a bit of a nuance to this, right? A lot of people go chasing this high score and they say, I need to create a credit history. When you go to a bank without a credit history, you obviously don't have a credit score, as a result of which they have a problem identifying what the rate is that they should give you. But should you be taking a loan to generate a credit score? This is a chicken and egg situation.
I think it's very funny when I got to know about this for the first time quite some time back. And I was wondering that when I go to the bank and they see that I don't have a loan, I would assume that I'm a better client for the bank, right? But like you rightly mentioned, they want to understand if at all you've taken a loan in the past and paid it on time, right? Because once you do that, it establishes the fact that they can lend money to you, and the risk on you is is much lower. It's also very surprising where when I looked at it for the first time, I thought that if I prepay my loan, right, the banks will be happier. Right, but what I really understand is that they are not from a scoring perspective, because they look at it in the sense saying that I don't have a steady cash flow, and because I got something at one time, I paid it off, and that impacts negatively.
This is an important point that you're making, and
Right.
we will address this over the course of the show.
So,
but to answer the question,
yeah, so the point that I'm trying to make is that there is no other way but for you to have a credit history, for you to get what you are really looking at. And which is why it's a very common practice, which is unfortunate, that you end up taking a small consumer loan to kind of create a history for yourself.
Yes.
That I'm a good borrower, and hence lend me a loan at a rate that I deserve to get a loan at.
is that a bad practice necessarily?
I'm assuming not if taken care of in the right way, because you only want to establish a fact that my credit worthiness is decent enough, and I'm not going overboard to kind of create a history for myself. So I can take a very small consumer loan, paid off on time, not prepaid, and that establishes the fact that the bank should look at me as a low risk entity that they really want to lend to.
So there were a few terminologies that you used when you spoke about the credit score, right? Credit worthiness was one of them. The credit score itself is one of them. And you spoke about a range. But let's talk about how this range or how this score is calculated. Is it only dependent on the loans that you take, or are there other metrics involved? Like, for example, I've heard that the way that you pay your utilities, that comes into play, because for a lender that has never seen a loan being taken, or for somebody that has never taken a loan like Kirtan, is he paying his mobile bill on time? Is he paying his electricity bill on time? Are his utilities being paid for? Is that something that also comes into play?
Perfect. So let me just address how the score is calculated,
Yes.
and I think that will answer some
Yes.
of your questions. And obviously, a lot of the common consumers have these questions as well. One, when you look at your score, the score is an algorithm. I'm not going to get into analytics and technicalities of it, but to put it very, very simply, right? Like I earlier said, while calculating scores, we typically look at the information which is available in the report. Now, what does a report have? A report have information about your identity. A report have information around various credit facilities that you have serviced before. So, for an example, if you have taken a housing loan, if you have taken a car loan, if you have credit card, that's there in the report. And the payment history, repayment history is also available in the report. And if you have paid on time with a great credit discipline, or were there any delinquencies, or you have missed some payments also, that's also there in the report. Along with this, what is also important section within the report is your inquiry section. So if you have applied for a credit, those inquiries, credit inquiries with the credit institutions are also available in the report. Now we use all of this information. And now what are the critical parameters that we look at when we arrive at score, or how the score works? One of the biggest aspects that you should look at is repayment history. So if you have a clean repayment track, like you said, taking loan is a great thing, because it enables a lot of things for common consumers. But servicing that on time, right? Taking care of your obligation is extremely critical. So the most critical aspect of your score is repayment track. That's the most critical aspect.
If you don't have that.
Now, if you don't have a repayment track, if you don't have a loan account that you have serviced, you don't have a score.
Right.
You don't get a score. Right. Another important aspect of score is credit mix. Now, what is credit mix? Now, again, let me just demystify it. In a common terms, there are loans can be divided into two parts.
Yes.
Right. There are loans which are collateralized, like housing loan, personal vehicle loan. And then there are loans which are unsecured, which come without collateral, like personal loan, the credit card. It doesn't have any asset backing it. So we look at a credit mix. What kind of loans one has taken? Has he taken only small multiple loans, like you said, or has he have 10 different credit cards, or does the consumer have a good mix of housing loan, a vehicle loan, couple of credit cards, and a personal loan, let's say.
So this is like an asset mix.
Good mix, right? A balanced mix always get you the right points. Then we also look at what kind of experience that you had, to the credit. So let's say if you have been servicing credit for like 10 years, right? It's higher the length, better it is, right? So we look at a vintage, how experienced you are when it comes to servicing the credit. That's another point that we look at. Another important point that we look at is utilization, and especially when it comes to credit card, let's say at a personal level, you have credit limits which are offered.
Yes.
Are you maxing those credit limits, or are you using that limit very prudently?
Right.
You're within the limit, right? Using whenever you need it, but within the limit. That's something that we look at. And the last very, very critical point is your inquiries. Now, what I mean by inquiries, now there are two types of inquiries, and you might have that as a question. I can see that. A lot of consumer ends up asking that if I inquire on my own report, does it impact my score? Let me say that very clearly here is no. The answer is no. When you inquire, it doesn't impact your score, and I'll come to that, but your inquiries do not get reported.
But the
on the
lending
report.
Institutions...
Only when you apply for a credit, those inquiries. So when you apply for a credit institution come to us with your data, and they pull your report. That inquiry get registered on the credit report.
So I have a question here, though.
And these aspects get covered in the score.
But before we get to that, you spoke about a range between 300 and 900. What is considered a good score?
Okay, so it depends upon...
See, he's got the answer.
Yeah, so, he will definitely agree with me on this. It depends upon institution to institution.
Right.
For an example, if you go to, a lot of public and private sector large banks, you will look at their interest rates are a little different, right? Little on a lower level.
Yeah.
If you go to, NBFCs and fintechs, their interest rate might be a little higher, right? So it depends upon credit institutions and their risk appetite. If you have a score very, very close to, let's say 900, better it is for you.
Okay.
Right?
So closer to 900.
Closer to 900, and putting a specific number, will not do a justice to it. Basically because, there are so many institutions who are operating in a wide range between, let's say, 650 to, 750 and above, right? 750 and above, clearly.
Okay.
Yeah.
So, okay. We'll come back to this in a minute because I've got lots of questions here.
Yes.
But one of the aspects that you spoke about was the credit card and the usage of credit card. Kirtan, this is something that now is very pervasive. Everybody goes out, swipes their credit card. It's very easy to do. Transactions have gotten so much easier. The number of people that are offering you things on credit card loans has gone up immensely. But are there do's and don'ts in your opinion? And should you stay away from the credit card if you have certain proclivities? Let's ask you that.
I think thanks to the influencing community, all of us want to gather more points on our credit cards.
Yeah.
I think there are 3-4 things that immediately strike me when you ask me this question. I think the first thing that people really have to understand is points are an output of a discipline that you will follow to procure and maintain a credit card, right? Because if you don't make your payments on time, you're going to be charged anywhere between 36 to 42% for late payment.
Per year,
Interest,
annualized,
right? That's crazy, right? Also, I have unfortunately seen a lot of people don't even know this, that the minimum payment that you make does not stop you from getting penalized on the interest for the other payments that you've not made, right? I was doing some math so a 50,000 of bill that you had to pay at the end of the month, the minimum payment is roughly 5% of that on and off, right? So 2,500 is your minimum payment to make on a 50,000 rupee bill. When you make that payment, you're only paying 750 of principal and 1,750 as interest. And you are still going to continue to pay interest on the remaining amount that you've not paid.
And it compounds.
Right. It'll take 10 years for you to close this loan if you keep paying minimum payments. Right? It's crazy. Third, he's already highlighted. The third one is that you don't try and max out your card. Right? Because the way I'm assuming that the CIBIL system works is if you have 2 lakhs of credit availability and you max out 2 lakhs every time, they will understand or feel that you don't have the monies, which is why you're using this credit, right? I don't know what the right number is, but 50 to 70% of usage seems easy and doable, right? Don't go beyond that. And the last is, unfortunately, I've seen a lot of people even use credit cards to withdraw cash. Never do that mistake is because Typically, a card gives you 45 to 48 days of credit period. As soon as you swipe it for cash, right, from day zero, they start charging you interest on the cash, and every transaction that you do after that, even if it is not cash, is without any credit.
So a couple of things that have emerged even from this, right? Which is the second aspect that he spoke about. If you have a limit, and it's fairly easy, a lot of companies now, a lot of banks offering you credit cards, and the overall limit that you get given is quite a significant amount. And of course, a lot of people know that you can actually restrict that. You can cut your spend, and you can put a wall, so to speak, to restrict the amount that you do spend on that card. What do you look at as CIBIL to say if you are consuming 80%, 90% of that credit limit, is that a bad thing? And what is a threshold to bear in mind here?
I think you mentioned it nicely. If you are utilizing credit and maxing out the credit, it shows the kind of stress that you have on your finances, right? If you are using credit well within the limit, right, that itself is good enough.
So like half, 70%?
Yeah, I mean, you know, as low as possible. Sure. So let's say, for example, if you are utilizing credit to the tune of 30 to 40%,
sure,
or 50%,
sure,
well within the limit,
right,
it makes sense.
Let me ask you this then: if you pay the minimum amount, does that negatively affect your credit score over a period of time?
It was something that
he did mention, but it's coming from you, right? I need to understand that.
Yes. So clearly, when you pay only the minimum amount, right, you're not defaulting.
You're not.
Yeah.
You're not defaulting. But your amount is due. The total amount is due. And there is a significant amount of money which is due, right, to the bank. What happens, you know, for the people who do it time and again, right, that builds up. Two parts. One, the amount itself builds up. The second, the late fees and the interest payment also, you know, comes with it, and suddenly you don't realize the amount becomes bigger, and that's the problem.
Sure.
So I'll always advise that it should not be minimum amount due, but it should be total due that you should try to pay.
Okay.
While, you know, paying that minimum amount due will not hurt you in a short run, but definitely.
So just to confirm, I want to get this right. By paying your minimum amount, you're not defaulting, and so therefore that should not negatively affect your credit score. But at the same time, what normally happens is that your utilization of that credit limit over a period of time goes up, and so the first red flag that you identified, you said that you shouldn't be utilizing all this, that gets triggered, and that could negatively affect your credit score.
Absolutely. So there are multiple factors which keeps building. So
and you're studying behavioral trends, right? So you want to ensure that people are following the right way of using credit.
Absolutely.
Another question that I have with regard to the credit score, and this is something that a lot of people think about, there's no clarity. I haven't yet gotten clarity. I'm hoping to do that. Is that if you cancel a credit card, it is viewed as the shutting down of a line of credit, and that negatively affects your credit score. Is that correct, or is that false?
Again, it's a contextual. So for an example, if you have dozens of credit cards, shutting down few credit cards, you know, out of them is actually advisable, right? Because at the end of the day, the discipline, the cadence with which you will manage your payments, you will get into trouble if you are trying to manage multiple of them, right? What is extremely critical is have few credit cards and use them judiciously, right? Pay on time. Some of the factors that one should keep in mind is some of the times we have credit cards. So for example, you know, I have one credit card that I have been servicing for, let's say, last 10 years. Now, what it does to my, you know, credit profile, it talks about the vintage that I have. I have been servicing that credit card for last 10 years. I have been paying on time. So all that history in a live, you know, with a live credit card gets reported, and it helps me, right, build my credit profile. If I shut that down, that's the trade that I'm shutting down, right? One. Second, when it comes to, you know, credit card utilization, right? It's better to have few credit cards, like I said earlier. Right? Because again, the discipline around it, that's the second important, you know, aspect that will help you build up a good credit profile when it comes to managing the discipline and managing the repayment on time.
Okay.
Right?
Cool. So that's clear. When it comes to going out, once you've established that you have not necessarily, and this is the example that I started with, Kirtan, if you don't necessarily have the best credit score, chances are that you're going to be paying much more than you would normally pay, right? So is it better to defer a payment, in your opinion, as somebody that advises people on their finances, to defer the purchase, for example, of a house, if the differential is as much as a percentage point or more on that home loan, because it could cost you significantly more, build up your credit score and then come back?
I think, Alex, the way to really look at it is because we call it personal finance, and the prime reason to it is it's very personal to each individual, right? I think it'll really depend on how because of the lack of the right adjective here, how desperately is the purchase required in case of every individual. Of course, theoretically, you and I both will agree that a percentage point over a 20-25 year loan will make a lot of difference, right? Of course, there is an option that probably 3-4 years later you might want to refinance it at a lower rate when your credit score improves and another bank is willing to give it to you at a lower rate. But I think conceptually you might want to do this, but practically it will depend on case-to-case basis. But even in the worst case, let's say somebody requires a loan, ideally the way to do it is just take it because you need it at this point in time, work on your credit score in the meanwhile, and once you've been able to go above the 750 mark, which I thought was the norm that people talk about, right, you might want to approach another bank and get a refinance at a lower rate.
Okay. How quickly does your credit score get negatively impacted, and how quickly can you bring it back?
Okay. So credit score and report is a trust artifact. And there is a saying which goes like, trust is built in drops and lost in buckets, right? Similarly, when you build credit profile, it takes a lot of discipline and consistency. That's the key, right? It's not like running a sprint. It's like, a marathon. Those small steps, not very rigorous, but very consistent steps gets you there. So you have to build it over a period of time. And what happens is sometimes certain delinquencies, when I mean delinquencies is non-payment of the dues, that definitely impacts your score. And the moment lenders report it to us, it brings your score down. So one of the first things that I will urge viewers to look at when they want to build a good credit score is to repay on time.
Sure.
All the time.
So we've established that, but I'm trying to understand if you have had an impact on your score.
Yes.
You said it reflects within days, I would assume.
Yes.
And you drop quite considerably. How long would it take for you to come back if you go back to normal?
Okay, great question, and I want to answer it in a couple of ways. One, immediately answering your question. If you want to come back on track and build a good score, want to go back to that good score, first thing that you should do is repay the outstanding amount, right? The moment you repay the outstanding amount and it starts reflecting, I mean the lenders receive it and they report to us, you will immediately see some correction, in your score, a positive impact. Now bringing the score again back to a very, very good level, again will take a little bit of a time. Right? You have to show that behavior consistently over the next
But is it few months or is it years?
No, it's few months, right? And it's again contextual. It depends upon what kind of behavior you displayed.
Last question to you. And I think there are a lot of people out there, unfortunately, because they get into bad habits, that end up piling up debt in the cycle. And here we normally talk about in terms of a waterfall. There's you keep going higher in terms of the interest that you pay, because you go into unsecured, which is your personal loan, in order to pay your other loans, credit card loans. So there are ways in which to get rid of that. What is the best way in your opinion, and there's no single way, what is the best way to try and get your life back on track if you are perhaps getting stuck in a spiral?
No, I think the best way to do it is, of course, to get rid of all the loans, but you will have to prioritize, because the problem you are in is because you don't have the monies, right? So now if you have 4 or 5 loans that are outstanding, what you really want to do is pay off the worst. Pay off the worst of the loans first, right? Because they are going to compound in a bad way, much higher than the smaller interest rate loans will compound. So I think if you are in that spiral, all you want to do is first prioritize, understand which is the worst amongst all the loans. When I say worst, I mean who's charging you the higher interest rate, which probably is credit card and then personal loans and then the other ones. And you want to do that first before you end up paying the others, right? But if you have the monies available, you might want to spread that across. Let's say if you end up doing a minimum payment here, right, on the credit card, and at the same time take care of your personal loans, probably that might help you not hurt your CIBIL in the near term, but also make sure that you are paying off everything together. Right.
Last question. How much of your monthly outgo or monthly amount that you get in your bank account through income should you be paying as an EMI?
I personally follow and suggest people to follow the 40-30-30 rule. What I do in that is very simple. If my income is 100, the maximum that I want to spend on my lifestyle and expenses is 30 rupees. 40 rupees I want to save, and 30 is the maximum EMI that I want to have. If you do this, there is a simple math that says in 180 months, which is 15 years, you probably will be financially independent. You will have more money coming to you as interest on this investment than what you typically will end up spending.
And there's something to aspire to. Not everybody can start at 40%, but you build towards that. Gentlemen, thank you so much for taking the time. Pleasure speaking with you. Now, I'm sure that there are a few questions that you might still have about your credit score and anything else personal finance related. I'd encourage you to write to us in the comment section. And do stay tuned, lots more coming up on NDTV Profit.